The US market continues to tumble yesterday, but at a lower magnitude of losses due to some comforting remarks out from Israel stating that they will not target Iranian oil assets in the near future as the Iran-US war head into the 21-day without any signs of de-escalation. Gold price continues to tumble yesterday by around 3%, and in the past two sessions from Wednesday to Thursday, a total loss of 7%, and gold managed to hit our minor support area at around 4,554, 4,500 before some stabilization set in. The US dollar shed losses yesterday at around a negative 1.5% due to a much more hawkish press conference and hawkish monetary policy statement coming out from key central banks, which is the ECB, the European Central Bank, and the Bank of England. And over here in Asia Pacific, we do see a bit of mixed performance over here in the intraday movement as we are speaking right now at 11:06 a.m. with the closure of the Japanese stock market. And oil prices dipped yesterday by around -3 to -4% due to the Israeli remarks stating that they may not hit Iranian oil assets in this ongoing US-Iran war. But however, the West Texas crude oil managed to find support at our key lower range neutrality limit, which we highlighted yesterday at the $92.60 US dollar per barrel. Very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. So today will be the Friday, the 20th of March, 2026. So let's have a quick look at the disclaimer first, as usual. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so now let us now take a look at the key events that has taken shape yesterday. So yesterday, key events will be more pertaining to the FX market because we know that FX market things are relative over here. So what we could see is that earlier on, the dollar strength after the FOMC meeting, which is on Wednesday, Singapore time, 2 a.m., 19th of March. That being said, that the Fed will not be able to hike rates or will not be able to cut rates this year, pardon me. So that actually led to the strengthening of the US dollar. But on the other hand, we also got to take note of the monetary policy stances from other central bankers because in the FX market, things are relative. So it's always US dollar against something or other currency against another respective currency like the euro versus the sterling. So over here yesterday, the situation is being focused on other key central bank that could drive the movement of the US dollar on a relative basis, which is the ECB and the Bank of England. So before we go into the ECB and the Bank of England decision over here, so let me we call it change my screen. Hopefully the screen works. Okay, I think this should be, yeah, good. This is the screen. All right. So yesterday, in terms of the rates, right, both central bank maintain interest rate unchanged. All right. So with the Bank of England maintaining interest rate unchanged at 3.75% over here, no change. But however, due to the monetary policy statement that was released, which is rather hawkish, so that actually implies that going forward, the Bank of England officials are pretty much concerned about the secondary impact on firmer higher oil prices into the UK real economy over here. So at this point in time, the UK is dependency on imported energy, and it makes it more vulnerable to supply shortages caused by the attacks in the Persian Gulf over here. So overall, what we could see now is that the markets are now implying at least 2 quarter point increases by year end. A massive U-turn compared with a month ago. All right here. So a month ago, there was actually risk about economic slowdown in the UK economy, and based on the economic slowdown, the central bank would cut rates going forward. But however, due to the rising geopolitical risk premium that is centered on oil supply shock, that created a massive U-turn, and the rates markets in UK is now pricing at least 2 quarter point increases by year end. after Bank of England rather hawkish monetary policy statement yesterday. So at that point in time, then there was a speech being made by the Bank of England Governor Bailey. So traders trim bets. Their bets means their interest rate hike bets later in the session after Bailey, which is the Bank of England governor, cautioned against strong conclusion about interest rate hikes. Right. So after his remark, the year-end pricing implies about 60 basis point of tightening compared to as much as 78 basis point earlier. So 60 basis point is also considered as two full interest rate hike expectation, because most of the time central banks right now has a convention hiking or cutting of 25 basis point each at one time. So 60 basis point, if represents about what, 2.5 cuts if you look at the way, because if they do it 25 they were 50, so 50, then you have the additional 10 more points. So that's equivalent pricing about 2.5 standardized interest rate hike of 25 basis point each. So market is still expecting the Bank of England to at least hike 2 times before 2026 ends, by this pricing in of a 60 basis point by the shorter term interest rate, we call it market, or the overnight swap market in the UK financial markets, or the UK rates market, despite the fact that the Bank of England governor came in and kind of cautioned the kind of hawkish view that is being implied on the swaps market in the UK over here. And over in ECB, so ECB over here, at that, let me share with you what ECB over here. So ECB also keep rates on hold, no change. So at this, let me go to the calendar. So for ECB, the depo rate is still at 2%, but however, during the okay, where is it? Let me go back. I think the screen is hanging. Okay, where is it? Over here. Yes. So but warns that Iran war could stoke inflation. So during the press conference by the ECB boss herself, President Lagarde, saying that inflation risk is tilted to the upside, growth outlook tilted to the downside. So overall, stagflation fear, but she's pretty much concerned about material impact on near-term inflation. All right, so at this point in time, they are more concerned about the inflation negative feedback loop on the wider Eurozone economy, rather than the other equation where growth could slow down thereafter, which is this is where the stagflation situation comes into play. Oil supply shock, higher oil, higher cost of doing things, higher cost of food and getting resources. Then thereafter, people will start to lower their purchasing power. In turn, consumer business demand got tempered off, then where we start to see weaker growth coming into the equation. But the ECB is not concerned about the third order impact of stagflation, which is the lower growth, but now more concerned about the first and second order impact, which is the negative feedback loop on oil supply getting much more prevalent, leading to higher spiral in oil prices that could have a significant material impact in the near-term inflation expectation and the actual inflation rate. So because of this kind of a emphasis, the short-term interest rate market in the Eurozone, or we call it the overnight swap market, the traders over there now has started to fully price in also 2 quarter point hikes this year from Eurozone. Okay, that means total of 50 basis points. So what we could see over here is that this is the equation that changes. Earlier on Wednesday, that means Singapore time Thursday, we see the dollar strengthening because the US Federal Reserve cautious about the stagflation risk as well. They're also concerned about inflation. So they themselves have painted a picture that they may not move this year to continue their interest rate cut cycle. So bear in mind that they are late in the cut cycle. So the Fed only cut interest rate in late last year. In fact, around fourth quarter of last year, or somewhere towards the late third quarter, where they do 3 interest rate cut. And earlier on this year, there was a pricing of at least 2 to 3 interest rate cut before the US-Iran war erupted on the 28th of February. So right now, things get changes over here. So the next interest rate cut by the Fed will starts to push all the way down until 2027. So that's why the dollar rose yesterday. But right now, we start to see relatively a much more hawkish ECB and Bank of England compared to the Fed. all right, over here. So that actually changes the equation and causes market participants to have two interest rate hike by both ECB and Bank of England, whereas the Fed do nothings and they stand pat. So that created a we call it a change of market expectation, where interest rate in Eurozone and UK start with short-term interest rate tends to be much higher as compared to the interest rate in the US. So that actually causes a short-term flow of funds flowing away from the US money markets to the money markets in ECB and Eurozone. So that causes the US dollar index to reverse their earlier gains that's being seen exposed FOMC yesterday. So let me share with you, there are three things to take note of in terms of the technical of the US dollar index, which is very important in terms of the levels and the price structure. So what we could see over here is that the US dollar index in general will be the sentiment of the US dollar. Since the high of late May last year, 29th of May, it has been trapped in this complex sideways range configuration. All right, every time it hit the upper limit of the range between 110, 154, price action reacted. Every time it hit the lower limit of the range around this 96.30, 95.50 level, price rebounded. So what we could see in the last two sessions, there's a struggle. Once price action hit the upper limit of this key medium-term range resistance at around 100.10/100.54, price action resided. So what we could see is that this push up earlier on the exposed, let me expand the screen. Yeah, it's over here. So this rebound that's being seen on my screen, maybe I just put it here so that you guys, I change the cursor. I think this is the one, yeah. So this rebound over here is being led by no interest rate. We call it cut expectation by the Fed. Okay, rebounded, hit the range resistance level again, 100.10, 100.54. Then yesterday we have rather hawkish ECB and Bank of England monetary policy guidance that causes the US dollar index to plummet, erasing the prior FOMC gain down by negative 1.07%. And this decline of negative 1.07% broke below a important price structure, which is this former minor swing high of 99.49, previously becomes a pullback support, now turns into a pullback resistance level. All right. And if you look at the price structure of the momentum indicator, so momentum indicator is a rate of change. So anything that's rate of change has a higher signaling impact as compared to the raw price action. So let me take you through the rate of change over here. Okay, so this is the rate of change. So you notice that every time there's this bearish breakdown of a parallel ascending trendline support on the daily RSI, which is previously on the 26th of November last year, it led to a decline back towards the lower limit of the medium-term range configuration on the US dollar index at that point in time. Over here, much more earlier, on the 20th of January this year, a bearish breakdown from this parallel ascending trendline support also lead to the US dollar index to plummet towards the range, lower limit of this complex sideways range. And right now, we are seeing this again happening over here. So it plummeted earlier on the 17th of March, retested it on FOMC day, and did that bearish reaction, expose Bank of England and expose ECB. So very clearly, the price structure now has changed based on the relationship where the RSI impacted the movement on the raw price action on the US dollar index. So right now, what we could see over here is that the RSI have a leading element where it did a bearish breakdown and a bearish reaction. So now there's a higher chance that what we could see is that the US dollar strength that was being seen at the start of this week got eradicated, and potentially we may see kind of near-term weakness coming into the US dollar index for it to float back down towards the lower limit of this medium-term complex sideways range configuration that has been in play since May last year. And what's important is that if you take into the intermarket perspective, by looking at the difference between short-term interest rates of the US versus short-term interest rate as a basket against the key major economy. So what I did over here, this purple line is the 2-year US Treasury yield. So we know that 2-year rates or 2-year sovereign bond rates are very sensitive to their respective monetary policy stances of the various central banks that if I want to observe. So I get is that because this is the dollar index, so I get the US 2-year treasury yield, I minus off the 2-year treasury government bond yield of the respective major economy, Germany, UK, Japan, Canada, Swiss, Australia, and China, divided accordingly to equal weightage. So what we could see is that the difference of this yield spread between the US 2-year treasury yield spread and the rest of the world major economy 2-year government bond yield, so this is a yield spread, I'll put it away, continues to decline. All right, so what we could see over here is that if I were to do a descending trend line, okay, price action is still being kept by this descending trend line. And if you look at from the low of 9th of March all the way up to the high of 18th of March. So this 9th of March is where the rebound of the US dollar began at the start of this week. All right, this push up over here. All right, so if you look at the yield spread between the US 2-year treasury yield minus the 2-year government bond yield of those respective key economies weighted on a equal weightage basis. So you realize that they also have a bearish breakdown as well. All right. So from an intermarket perspective, it's also supporting a weaker US dollar, given that the rest of the world 2-year government bond yield is now trading at a potential higher level as compared to the 2-year, or put it away that the 2-year treasury yield premium against the rest of the world has shrunk. All right, so that makes the US dollar as a less attractive money market investment. So I'll talk about money market over here. That means short-term interest rate. All right, so that actually support the price structure movement, taking into account of the current macro picture of what we are seeing in the Eurozone that taking shape yesterday, of ECB and UK, which is the latest monetary policy guidance over here in the UK economy as being portrayed by the Bank of England hawkish monetary policy statement. And on the other hand, another part of it will be the story of the yen itself. So we know that the yen is rather weak in the last few sessions as well. So right now, the yen also taking a ride from a stronger euro and a stronger sterling that causes the dollar yen to plummet. And yesterday, we also have a rather hawkish press conference as being him by this Bank of Japan Governor Uda after the Bank of Japan keep interest rate unchanged at 0.75%. So the yen strengthened against the dollar as Bank of Japan Governor spoke about the central bank decision to keep its benchmark rate unchanged. So what Uda mentioned that the wage talks. So every start of a new financial year in Japan. So Japan new financial year starts on the 1st of April this year until 31st of March next year. So before the start of any new financial year, there will be this spring talk negotiation. This is compulsory because is between the Japanese union and the respective Japanese companies. So in the last 3 years, wage increase has been around 3 to 5% on the way, or 5% for some or more, 5% in fact. So Uda, based on his own assessment, saying that wage stocks has been delivering solid results, and authorities, which is BOJ, need to keep monitoring the impact of currency movement on prices. So he said that the wage stocks has been delivering solid results so far, and it's possible to grasp the direction of the price trends in the near term. And he also mentioned that authorities need to keep monitoring the impact of currency movement on prices, as moves may have more impact on prices than before. So because of this situation here, he's have a belief that wages will continue to rise this year, and also because of the weakness of the yen could have a secondary knock-on second-order negative impact on the Japanese economy by creating higher cost of living for the Japanese, and that could cramp down consumer spending and lower consumer confidence. And he believed that moves may have more impact on prices than before. That means a weaker yen now could have a much more secondary impact on the real economy than before. So because of this statement, it's rather hawkish. that actually also causes the dollar yen to weaken yesterday as well over here. All right, so that is the FX market situation over here. So over in the US market, so US market, we see still a rather weak movement. Later I'll show you the heat map of the S&P 500. So very quickly, the S&P is down by negative 0.27%. Nasdaq, same magnitude, down by negative 0.29. The Dow Jones down by negative 0.44. The Russell 2000 down by negative 0.65. So if you look at the heat map yesterday of the S&P 500, so I could see there are more reds than green. Okay, give me a minute. Yeah, there are more reds than green over here. So the one that is only in green is the energy over here, despite the fact that the oil prices slide yesterday to around negative 3 to 4%, but energy stocks continues to help pretty firmly yesterday. So if you look at the heat map of the S&P 500 in terms of separating according to the 11 key sector. So yesterday performance, the top performer still is energy, positive 1.6%. A marginal gain on technology sector, up by 0.14%. Then the rest you see all close in the red. All right, over here. So in terms of the breadth on the S&P 500 is still rather weak yesterday. All right, so more and more sectors are trading lower. Only the energy sector is higher, significantly positive 1.6% due to the market expectation that oil prices may continue to be much firmer, despite we have this Iran news flow stating that Israel said it will not strike Iranian energy sites for now, because in the last 2 days, oil prices spiked because of this to and from attack from both sides, where Israel hit a Iranian, I think, major gas facility, that Iranian hit back Gulf states oil assets. So that could create a upward spiral in oil prices as the sentiment towards oil supply shock gets more deepened. So yesterday, Israel said that it will not strike Iranian energy after Trump's rebuke to it over here. So we know that US now is getting a bit uncomfortable with higher oil prices. Bear in mind that that could actually hurt Trump's Republican Party showing in the midterm elections that's going to be held at the end of this year. All right, so these are the key news flow that has taken shape yesterday. So let us now focus our attention to the second segment of the daily dose, which is the intraday technical outlook segment. All right, so let me expand my screen. Okay, so let's start with the FX market. Okay, so over in the FX market, if you could recall yesterday, because we will have a neutral stand on the euro dollar because of the risk of if ECB were to be much more hawkish than what markets portray. Indeed, it did take shape because we were neutral between this 155 level and the lower limit at 114.55 over here. So what it did over here is that it clear past the upper limit at the 150.65, 155 level, hit the next resistance at 116.05 before doing that minor pullback as we are speaking right now. Okay, there's a minor pullback that's taking shape right now over here, which is on the start of the last 2 hours of the US session. All right, over here. So with this minor pullback that's taking shape over here, and the hourly RSI that has starts to exit from the overbought level, so there could be a pullback taking into account at the start of the European session as traders pare back their speculative net long position yesterday. So what we do over here is that we will have a bullish bias now, given that yesterday's strong push up above the upper neutrality limit of the range. So neutral will be this zone over here. Let's put a zone. Okay, and if you do the Fibo retracement of yesterday's push up all the way up to the US session high, that also coincide with the 61.8/76.4% Fibo retracement. So that will be at a 115.18, 140.90. Let me slash it, zone 140.90. Okay, so this will be my short-term pivotal support zone to flip back to a bullish bias on the euro dollar in the near term above 16.05, potentially take us up higher today at 16.73. Only a bearish breakdown below 114.18, 115.18, 114.90, then the bulls will get negated to retest this minor range low of 19th of March at 14.55. Breaking down below 14.55 may expose further weakness to the psychological level at 114 figure level, right? And 114 figure level, if you go back in time over here, okay, it also coincide with the minor swing low of 30th of July and 1st of August last year. All right, so flipping back to a near-term bullish bias on the euro dollar using 115.18, 140.90 as the short-term pivotal support. Next up will be the sterling dollar. So the sterling dollar also broke above our upper neutrality limit at the 135.70 level and also did a bullish breakout from this medium-term descending channel resistance that was previously drawn from the high of 28th of January this year. So very clearly, this bullish breakout potentially could alter the trend movement of the sterling dollar as it exit from a multi-week medium-term downtrend. So what we do over here is that we will have a rather tightened short-term pivotal support level, and this tightened short-term pivotal support level also confluence with the lower with the former medium-term descending channel now turns into a pullback support over here as well, and so slightly below the 20-day moving average. So 135.70 short-term pivotal support level on the sterling dollar, flip back to a bullish bias above 134.50 resistance that was being stored yesterday during the last 2 hours of the US session, may potentially seek out the next intermediate resistance level at 135.05, which confluence with the 50-day moving average as well. Breaking below 135.70 will negate this bullish bias view for today and see it floating down back towards yesterday's low area and at 132.60. Okay, breaking 132.60 will expose the all-important last Friday minor swing low at 132.20. Right, so that's for the sterling dollar. Next up will be, sorry about that, will be the Australia dollar. So let me get the chart out for the Australia dollar first. All right, so the Australia dollar has been one of the firmer currency against the US dollar as it continues to held above the 50-day moving average and the 200-day moving average, which is right at the bottom over here. So what we could see is that in the last few sessions, it has been sandwiched between the 20-day and the 50-day moving average, and right now it's attempting to break past above the 20-day moving average again. After yesterday, it managed to survive at our pivotal support level that we highlighted at 70.15. So indeed, 70.15 did attract near-term deep buyers coming back into the Aussie dollar. So 70.15, 70.15 is indeed a key short-term pivotal support for the bulls to maintain their near-term bullish momentum. So levels remains unchanged for now. Support resistance level to clear the zone, the first intermediate resistance level to clear will be 71.20, 71.40. Above 71.40, potentially seek out 71.90, which is very close to the current year-to-date high, and as well as the minor swing high of 11 of March over here. All right, so breaking down below 70.15 will invalidate this bullish bias on the Aussie dollar for it to slip down towards 69.80, which is the 50-day moving average. Below 69.80 may expose further near-term weakness towards 69.44, which is the swing low of 3rd of March, very close to the 69.10 key medium-term pivotal support level. So if you price action manage to do an hourly breakout and an hourly close above 71.40 over here, the upper limit of this near-term resistance zone, then I will tighten my pivotal support level from 70.15 to 70.58 over here. All right, so that's for the Aussie dollar, still maintaining our bullish bias. Next up will be the dollar yen. All right, so the dollar yen didn't rally as expected to hit the 160.23 level, and it tumbled downwards. And it also broke below this minor ascending channel support drawn from the low of 27th of February. So what we could see is that it tumbled all the way down to our alternative view support level. So if we have a breakdown below 15903, price action tumbled and it almost hit the next support level at 15740, printed a low of this 15751 over here, which is also confluence with the 20-day moving average over here. All right, so with that, now price action has exited from the oversold level. So right now there could be some form of a bounce coming into play, but I will use this bounce to fade the bounce to observe any weakness that has started to appear in the hourly dollar yen price action thereafter during the European session to flip to a bearish bias over here using the pullback area of that former minor ascending channel support. Now that's the pullback resistance level. And if you do the Fibo retracement of yesterday's sell-off from the Wednesday ex-post FOMC high all the way down to yesterday's US session low, that also coincide with the 61.8/76.4 Fibo retracement. So using 159.03/159.37 short-term pivotal resistance zone to fade any strength, be on the lookout of any weakness that's being seen on the hourly time frame or the 15-minute time frame on the dollar yen. Near-term support 157.40, breaking below 157.40 may expose further weakness towards the 50-day moving average in the first step, which confluence with the swing low of 5th of March at 156.55. Only a clearance above 159.37 and an hourly close above it will invalidate this bearish movement and see a squeeze back up towards the intervention risk zone again at 160.23, 160.74. Maximum will be the key long-term pivotal resistance level at 161.7, 161.95. All right, so that's for the dollar yen. Next will be the major benchmark stock indices over here. Okay, hopefully the screen is up. I think it's a bit lagging right now. Okay, not this one. Yeah, this is the one. Okay, give me a couple of seconds. It's a bit lagging. All right, I think it should be good. It should be all good. Yeah, the screen is good. All right, so let's start with the Hong Kong 33 first over here. So the Hong 33 that is representing the Hang Seng Index over here. So it continues to remain in a lackluster fashion. So in early today's Asia session, it attempting to bounce at the open, but it formed a bearish shooting star candlestick on the hourly chart at the first hour of the Hong Kong stock market. Also still below the 20-day moving average. So given that it kind of form a bit of near-term support at this 25,187 level. So I do not want to shift that short-term pivotal. Okay, so what I do over here is that I'll use this 200-day moving average, given it is Friday over here, so have a much more better risk management perspective. So I will shift it down to 25,800. All right, over here. I round it to 800. Okay, let me adjust this. Okay, so this will be the next resistance. Okay, everything's adjusted. All right, so using a rather tightened short-term pivotal resistance for better risk management, 25,800, we saw confluence with the 200-day moving average. Near-term support level, yesterday's US session minus swing low, today's level where it managed to survive, 25,187. Below 25,187 exposes the long-term pivotal support again at 24,765, which is very close to the night of Monday Asia session swing low. A clearance above 25,800 will invalidate today's bearish bias view to see a squeeze up to retest the minor swing high of 11th of March and 17th of March at 26,147 next. Right, so that's for the Hong Kong 33. Next will be the Japan 225 that is representing the Nikkei 225. So the Japan cash market is closed for holiday today. So price actions still are still traded because of the Nikkei 225 futures that is still trading in Globex. All right. So what we could see is that the hourly RSI yesterday exited from the oversold level. So right now we are seeing a bounce back again towards the pullback line of this former minor ascending trendline support drawn from the low of 9 of March, now turns to a pullback resistance. So no change, given that it's now confluencing with the 54,900 short-term pivotal resistance that we have previously, and also the 50-day moving average as well. So still using 54,900 to fit any potential rebound that we may take shape right now. At 54,900 short-term pivotal resistance, maintain that bearish bias view. Breaking below 59,135 for a retest to it will expose 51,055, which is the swing low of 9 of March. Only a clearance and hourly close above 54,900 will invalidate today's bearish view to see a squeeze up to retest 54,760, 56,626, 55,760 confluence with the 20-day moving average, 56,626, which is the minor swing high of 5th of March. So that's for the Japan 225. Next will be the Germany 30. So the Germany 30 yesterday, we flipped to a bearish bias. Bearish bias almost hit our support level, which is the swing low area of 9 of March at 22,686. And right now, it's attempting to stage a rebound back to the former minor swing low, or this little range support over here that previously formed on 12th of March to 16th of March, now turns into a pullback resistance at around 23,281 over here. So what we could see is that the price action on the hourly RSI is now inching downwards, right, over here, after a bearish reaction from this pullback line, right, of this former trend line support now turns into a pullback resistance, and it did a bearish reaction right now as we are speaking. Also very close to the 23,281 former minor range support, now turns into pullback resistance. So with that, I will use a slightly higher level at 23,660 for today as my short-term pivotal resistance. That also confluence with the upper limit of this ongoing minor descending channel drawn from the high of 27th of February. So using 23,660 as my short-term pivotal resistance, maintain that bearish bias. Breaking below 22,686 exposes 22,312, which is the, if we go back in time, the minor swing low area of 28th of April and 1st of May last year. All right. So if price action today managed to do a bearish breakdown first, instead of doing a push up, it break down below 22,687, then I will tighten my pivotal support to 23,280. All right, over here below 22,312 exposes 21,930, 21,830, which is the lower limit of this minor descending channel, and the 2.618 Fibo extension of this ongoing corrective decline since the current all-time high of 13th of January this year. Only a bullish breakout and an hourly close above 23,660 that would invalidate today's bearish bias view to see a squeeze up towards 23,960, 24,162, and even 24,135, all confluencing with the 200-day, 20-day moving average, and as well as the minor swing high of 5th of March. So that's for the Germany 30. Next up will be the US Wall Street 30, representing the Dow Jones. So the US Wall Street 30 hit our support level as expected, 45,780, 45,735, and right now it's doing a bearish reaction by shaping a series of hourly, we call it shooting star candlestick that's being formed at 9 AM Singapore time, and it did that bearish reaction right exactly at the former long-term pivotal support at 46,330. So with that, I would do a rather tighter short-term pivotal resistance zone for today, which is slightly above 46,330, unless price action can do a bearish breakdown below 45,780, 45,735, then I will use the 46,330 as my short-term pivotal resistance. So short-term pivotal resistance zone will be at the 200-day moving average, 49,710, 46,710, pardon me, 46,973, which is the upper limit of this ongoing minor descending channel from the high of 26th of February. Maintain that bearish bias view. Next support level to watch, 45,237, 45,190, followed by 44,975, 44,810, which is the lower limit of this descending channel, and the 1.382 Fibo extension taken from the high of 10th of March. This taken from the high of 10th of February, the current all-time high, and if you go back in time, that also confluence with the congestion area of 19th of August and 21st of August last year. only a bullish breakout above 46,710/46,973 will invalidate today's bearish buyer's view to see a mean reversion rebound scenario unfolding again towards 46,470 and 47,800, which confluence with the downward sloping 20-day moving average. All right, so that's for US Wall Street 30, still maintaining that bearish buyer's view for today. The S&P 500, so the S&P 500 also tumbled down as expected over here. So what we could see is that it's now breaking below the 200-day moving average as well, at this 6,648 level over here, and now shaping that bearish reaction, right, as we are speaking. So I don't want to tighten it to be so tight at 6,648 unless it has a breakdown below 6,585. So right now the pivotal resistance level will be at 6,720. We're so very close to this upper limit of this minor descending channel drawn from the high of 26th of February. So still maintaining that bearish buyer's view, breaking below 6,585, exposes 6,535, 6,500. Below it may seek out a further weakness towards 6,420, which is the lower limit of this minor descending channel over here. And if you go back in time, 6,640, it's the congestion area of 3rd of September and 4th of September last year. All right, so this will be the SPX 500. However, breaking above 6,720 will see a mean reversion rebound taking shape again. In first step, targeting 6,755, 6,775. Above it may potentially expose 6,815 next. Lastly will be the Nasdaq 100 over here. So the Nasdaq 100 also did a push down over here, breaking below that 20-day, 200-day moving average, and right now trying to flirt back around the 20-day, 200-day moving average again. Right below this right below the swing high area of 19th of March during the Asia session at 24,549. So using a pivotal resistance level at 24,710, 24,800, still maintain a bearish bias view on the Nasdaq 100 over here, breaking below 24,280, 24,190, which is yesterday US session low, may expose further weakness towards 23,955, 23,840 over here, which is the 0.674 Fibo extension taken from the high of 28th of January. And if you go back in time, this is also the swing low area of 21st of November last year. All right. Only a bullish breakout above the pivotal resistance zone of 24,710, 24,800 will invalidate today's bearish buyer's view to see a squeeze back up towards 24,990. So 24,990 is the medium-term descending resistance from the high of 28th of January. Breaking above 24,990 will see a mean reversion rebound taking shape, extending towards 24,107, 25,107, pardon me, 25,192, which is the 50-day moving average, confluencing it as well. All right, so still maintaining that bearish buyer's view on the Nasdaq 100 using 24,710, 24,800 as the key short-term pivotal resistance zone for today. All right, so that sum up all the intraday technical outlook on the broad-based stock indices across the different region. So let us now take a look at the commodities market, starting with gold. So gold plummeted as expected after breaking below 4,960, which is the 50-day moving average. And right now we are doing a mean reversion rebound, all right, after yesterday's steep rebound. And yesterday's steep rebound also hit a typical wave 3 downside target of 1.618 Fibo extension. So what we could see over here is that this could be a little wave 1 in terms of the Fibo elliott wave perspective. Right, so let me put it in writing. Okay, wave 1, then you have the wave 2, and typically wave 3 will be the strongest, and it also hit a typical wave 3 target of 1.618 Fibo extension, starting from the high of wave 1, project it to the low of wave 1, put it up to the high of wave 2, then this gives you a typical downside wave 3 target of 1.368, 1.618. So it hit over here, right? 4,054, which we have 5,554. Then the low is slash 5,502. So right now it's doing a wave 4, right? Before another down move wave 5 takes place, right, over here. Okay, so typically a wave 4 after a steep down move of 1.618 tends to be at the 38.32 Fibo retracement, 50% retracement taking from the length of wave 3 that start from the high of wave 2. All right, so if you do it the Fibo retracement, so you see 38%, 50% coincide with around the graphical zone of 4,807, 4,870. Right, so with that, we will have a mild bullish bias for today to attempt this potential corrective wave 4 mean reversion rebound scenario. 4,554, 5,582 rebound scenario resistance zone. 4,807, 4,870. Above 4,870 exposes 4,968 slash 4,040. This zone over here, which confluence with the 50-day moving average, and as well as the upper limit of this medium term upper limit of this minor descending channel that I drew from the high of 2nd of March. All right, so flipping to a mild bullish bias for a potential mean reversion rebound using 5,554, 5,502 short-term pivotal support area. However, if price action didn't rebound as expected, and from here it just plunges downwards towards 4,554, 4,502, then this bearish impulsive upmove sequence will extend further towards the downside, exposing the next support level at 4,402, 4,380, which is a 2-time Fibo extension taken from the high of 2nd of March area over here. Below 4,380 may seek out 4,274, which is the minor swing low area of 12th of December, 16th of December, and 31st of December last year. All right, so that's for Gold XAU/USD, flipping to a mild bullish bias for today for the potential movement of this mean reversion rebound that could take shape. Lastly will be the West Texas crude oil over here. So looking at the daily chart of the West Texas crude oil, so far it has been trading in the sideways range over here after breaking above this Monday high. All right, so yesterday's sell-off of this negative 4.6% is due to that Israel statement stating that under the scolding of US President Trump that they may not hit Iranian oil assets in this ongoing US-Iran conflict. But however, price action on the hourly time frame managed to find support at our lower limit of the neutrality zone that we have, 92.60. So if you look at it, it's 92.60, very important where it bounces. It also bounces off from a parallel ascending, it bounces off from a minor ascending trendline support drawn from the 26th of February, where it managed to cap previous sell-off on 11th of March, cap previous sell-off on this 11th of March over here as well. And if you look at the hourly RSI now, it's also coming to some form of, wait, give me a minute. Okay, there's some form of support that is being formed as well, that is bouncing off it at around the 35 level, right over here. So overall, support is still being seen at around the 92.60 level. So we still maintain a range configuration. So it seems to us that it starts to consolidate in the sideways range. So for today, neutral between 102.25 and 92.60 for now, breaking above 102.25. For sure will unleash another round of bullish impulsive upmove sequence towards 111.28, followed by the current 4-year high area at 116.56 slash 119.54. All right, so that's for West Texas oil. So that pretty much sum up all the intraday technical outlook on the broad-based cross asset. So let's take a look at the economic calendar. What are the key data or events to look out for today? So event for sure will be still be the it will be the US-Iran war that is now entering its 21 day, showing no sign of a de-escalation at the moment. And economic calendar will be rather quiet today. Today will be the 20th of March. So if you go to the European session, not much key things to look up for as well. Nothing, don't know tier one data. So for those who are interested in the dollar CAD and the CAD crosses, we have some key tier one data from Canada, retail sales at 8:30 p.m. followed by the PPI data for Canada at 8:30 p.m. as well. And as we go to the US session, it's rather quiet over here. And there's this Fed Chair Powell public speech that will take shape on Sunday, Singapore time, 1:30 a.m. That means it's, then that could potentially influence the market when the market reopen in some form on the next coming Monday. All right. So with that, that will be today's Daily Dose wrap up. I wish you guys a great day and a restful weekend after a rather highly volatile movement in the markets this week. All right. Kelvin here, signing off, and we shall speak again next week, next Monday. Thank you.